A ripped stock analyst report floats by. You trust the experts, right? What if I told you a blindfolded monkey, throwing darts at stock listings, could select a portfolio that performs just as well as Wall Street's sharpest minds? This isn't an insult. It's the audacious core of Malkiel's random walk theory. Ignore this paradox, and you might miss the simplest, most profound truth in investing. We're challenging deeply held beliefs, unlocking fundamental market concepts, and preparing for a journey into investment's biggest truths and myths. 1. 2 paths to value. Welcome to Audiobook Bites, where we distill the wisdom of financial classics. Today, we're delving into Burton Malkiel's seminal work, A Random Walk Down Wall Street, and exploring Chapter 1, Firm Foundations versus Castles in the Air, 2 Paths to Value. If you've ever wondered how investors really value assets, this is for you. Malkiel opens with a profound insight, laying bare the 2 primary historical theories that have guided, and sometimes misguided, investors for centuries. As he notes, traditionally, the pros in the investment community have used one of 2 approaches to asset valuation: the firm foundation theory or the castle in the air theory. First, we have the firm foundation theory. Imagine an architect meticulously studying blueprints, soil samples, and material costs before laying a single brick. This theory, championed by figures like Benjamin Graham, posits that every investment, be it a stock or a piece of real estate, has an intrinsic value. This value is rooted in its fundamental prospects: future earnings, dividends, and tangible assets. A firm foundation investor isn't swayed by fleeting emotions. They believe diligent analysis can unearth a company's true worth. If the market price dips below this intrinsic value, it's a buying opportunity, because eventually the market will correct itself. This is the bedrock of value investing. But here's the twist. The market doesn't always behave rationally. Enter the castle in the air theory, famously articulated by economist John Maynard Keynes. This philosophy suggests that value isn't intrinsic at all, but rather, it's what the next person is willing to pay. Think of it like a newspaper beauty contest where the prize goes not to the prettiest face, but to the face you think others will consider the prettiest. It's a game of anticipating mass psychology, building castles in the air based on collective optimism and fads, hoping to sell them to a greater fool at an even higher price. The castle in the air theory of investing concentrates on psychic values. Malkiel writes, perfectly capturing this speculative dance. These 2 theories represent a fundamental divide in investment philosophy. On one side, the diligent value investor seeks undeniable worth. On the other, the growth investor, sometimes bordering on speculator, chases hot trends and popular sentiment. History has shown us that both approaches can lead to dramatic outcomes. Over-reliance on intrinsic value can mean missing out on explosive growth, while unchecked speculation can result in devastating collapses when the castles inevitably tumble. You might be thinking, isn't one clearly right and the other wrong? But Malkiel shows us the truth is far more nuanced. Understanding both is crucial, but market psychology often pulls prices far from that foundation, as we'll see with historical bubbles. Therefore, a balanced approach, one that acknowledges both fundamental worth and market sentiment, is essential for successful investing. Imagine waking up tomorrow and seeing a new, innovative company with no current earnings but a captivating story. How would you value it? Would you anchor to its non-existent fundamentals, or would you ride the wave of public excitement? Malkiel's work challenges us to recognize these forces. The bottom line: investment success hinges on recognizing whether you're building on firm ground or soaring on collective dreams, and understanding the inherent risks and rewards of each. If you want to continue building your financial wisdom and avoid costly mistakes, subscribe to Audiobook Bites so you don't miss our next deep dive into mastering your money. 2. Echoes from history's bubbles. Welcome back to Audiobook Bites, where we distill powerful insights from the world's most influential books. Today, we're delving into Burton Malkiel's classic, A Random Walk Down Wall Street, specifically exploring the fascinating and often alarming tales from the madness of crowds, echoes from history's bubbles. We're about to journey through history's most notorious speculative binges, uncovering the timeless psychological patterns that repeat across centuries. Picture 17th century Holland, a tranquil landscape where tulips bloomed, but something far wilder was taking root. Tulip mania, a newly introduced flower from Turkey. The tulip became an object of obsession, not for its beauty alone, but for a bizarre virus that caused its petals to develop dramatic stripes, making these bizarres incredibly sought after. Slowly, almost imperceptibly, popular taste began to dictate that the more unusual a bulb, the greater its cost. Soon, people were trading their land, their jewels, their entire livelihoods for these delicate bulbs. Everyone imagined the passion would last forever. It was pure greater fool thinking, buying something not for its intrinsic worth, but in the expectation that an even greater fool would pay more. The price of a single Semper Augustus tulip bulb could have fed a ship's crew for a year. But it gets worse. In January of 1637, prices increased 20-fold, only to suffer an even larger decline in February. Panic reigned, and fortunes vanished. Most bulbs became utterly worthless, no more valuable than a common onion. The market always corrects itself, sometimes with brutal swiftness. Move forward a century, across the Channel to England, where a similar madness unfolded. The South Sea Bubble. Imagine your broker calling, whispering about a new company with no sales, no earnings, just enormous riches on the horizon. The business? Secret. A con game, you'd think. Yet, in the early 1700s, investors were ravenous. The South Sea Company, initially formed to manage government debt, promised a monopoly on trade to the South Seas. A vague, yet intoxicating prospect of immense wealth. The stock price soared from £130 to £1,000 in a matter of months. But the frenzy wasn't limited to one company. Promoters, eager to exploit the insatiable craving for investment, launched a flood of new ventures, ranging from importing jackasses from Spain to making boards out of sawdust. One particularly audacious scheme was for a company for carrying on an undertaking of great advantage, but nobody to know what it is. Crowds literally beat down doors to subscribe. The promoter, not being greedy himself, promptly closed up shop and fled to the continent with the money. These were all bubbles, destined to pop. And when the South Sea bubble burst, big losers included none other than Isaac Newton, who exclaimed, "I can calculate the motions of heavenly bodies, but not the madness of people." The profound lesson here is that human psychology, driven by greed and the fear of missing out, can lead rational individuals to make truly irrational decisions. You might be thinking, that's ancient history. Surely we're too sophisticated for such follies today. But let's fast forward to the 1929 Wall Street crash, America's own spectacular boom and deafening bust. The Roaring Twenties, a period of unrivaled prosperity, fueled a national pastime: stock market speculation. Prices soared, sometimes 10 or 15 points a day. The firm foundation theory, which argues that each investment instrument has a firm anchor of intrinsic value, was drowned out by the siren song of the castle in the air theory, which Malkiel describes as concentrating on psychic values. People weren't buying companies. They were buying stories, hoping to sell to the next buyer at an even higher price. Manipulation was rampant. Investment pools would pump up stock prices with wash sales, creating the illusion of activity to draw in the public, then discreetly pull the plug, leaving the unsuspecting public holding worthless paper. Even the most esteemed figures, like Professor Irving Fisher, declared stocks had reached a permanently high plateau just before the crash. The Federal Reserve's attempts to curb speculation only intensified the market's freefall, leading to the devastating Great Depression. What do these historical narratives teach us? They underscore that while economic models often assume investors are completely rational, the reality is far messier. The human mind, influenced by overconfidence, biased judgments, herding, and loss aversion, can systematically deviate from rational behavior. When many investors, individuals and institutions alike, succumb to the castle in the air theory, believing they can profit by predicting what others will pay, rather than a security's fundamental value, the market becomes a dangerous playground. These errors don't cancel each other out. They often reinforce one another, creating massive bubbles. But Just knowing this history isn't enough. Therefore, the critical takeaway isn't merely that bubbles happen, but how to protect ourselves. You might be tempted to jump into the next hot investment, especially when everyone around you seems to be getting rich. However, this communal enthusiasm, what Malkiel calls herd mentality, is often a precursor to disappointment. The tendency to chase performance or ignore clear valuation signals, betting on the greater fool, is a recurring pattern. The bottom line, traditionally, the pros in the investment community have used one of two approaches to asset valuation: the firm foundation theory or the castle in the air theory. And when the crowd collectively builds castles in the air based on psychic values rather than firm foundations, the fall is inevitable and often catastrophic. If you want to build enduring wealth, you must resist the siren call of speculation and ground your investment decisions in sober reality, understanding that history, though sometimes surprising, often rhymes. If you found these insights valuable and want to stay informed about timeless investment wisdom, subscribe to Audiobook Bites so you don't miss our deep dives into financial classics that can save you from repeating history's most expensive mistakes. 3. The bubbles of the late 20th and early 21st centuries. Welcome back to Audiobook Bites, where today we continue our deep dive into Burton Malkiel's classic, A Random Walk Down Wall Street. We've looked at historical follies, but what about our recent past? Were we, in our modern financial sophistication, immune to the madness of crowds? Not at all. The turn of the millennium brought forth a new breed of speculative frenzy, more financially devastating than almost anything before it. We're talking about the internet bubble of the early 2000s and the US housing bubble that followed, costing trillions and shaking the global economy to its core. These weren't just minor corrections. They were colossal wealth destructions, proving that human psychology can trump even the most advanced financial models. First, the internet bubble. The late 1990s gave birth to the new economy narrative, a story of revolutionary technology and endless business opportunities online. Companies with no earnings, no sales, sometimes just a name with .com in it, saw their stock prices soar to astronomical heights. Investors abandoned traditional valuation metrics like price-to-earnings ratios. Instead, we heard talk of eyeballs and mind share as the new measures of worth. People were convinced that future growth was boundless, that the old rules no longer applied. But here's the catch. As Malkiel reminds us, the castle in the air theory of investing concentrates on psychic values. This era was a testament to that. The value wasn't in fundamentals, but in the collective dream of instant riches. Companies like pets.com, with a sock puppet mascot and a business model based on shipping low-margin kibble, went public, gained massive valuations, and then quickly imploded. The tragicomic Nortel stock joke illustrates it perfectly. Invest $1,000, and a year later it's worth $49. Invest that same $1,000 in beer, drink it, and return the cans for the deposit, and you'd have $79. It's a sobering thought. Narratives were compelling, but fundamentals were ignored. Therefore, a massive destruction of market value, estimated at over $8 trillion, evaporated into thin air. Then, just as the dust settled from the tech wreck, another bubble began to inflate, the US housing bubble. This one hit closer to home, quite literally, impacting the largest asset for most American families. Fueled by easy credit and innovative but deeply flawed financial instruments, lending standards loosened dramatically. Ninja loans, no income, no job, no assets, became frighteningly common. Banks created complex mortgage-backed securities and credit default swaps, bundling risky mortgages together and selling them as low-risk investments worldwide. It was financial alchemy. You might think that smart, rational players would have corrected these mispricings. But as Malkiel observes, it is clear that one cannot rely completely on arbitrage to smooth out any deviations of market prices from fundamental value. Constraints on short selling undoubtedly played a role in the propagation of the housing bubble during the end of the first decade of the 2000s. The ability of arbitrageurs to correct these imbalances was severely limited. Easy money and the widespread belief that housing prices only go up created a self-reinforcing cycle. But this easy credit led to unsustainable prices. Therefore, when the bubble burst in 2007, it triggered a global financial crisis. wiping out a third of home values on average and plunging the world into a painful recession. The bottom line, even with advanced financial tools and information at our fingertips, human emotions like greed and overconfidence remain powerful drivers of market behavior, leading to cycles of boom and bust that consistently remind us of the timeless lessons from financial history. 4. The illusion of patterns. In our continuing exploration of a random walk down Wall Street, we delve into one of the most tempting, yet ultimately misleading, paths investors often take: technical analysis. This is the art of the chartist, someone who believes the secret to future stock prices lies hidden in past movements and trading volumes. Imagine an investor, eyes glued to intricate charts, tracing patterns like head and shoulders or inverted bowls, convinced these shapes hold the key to untold riches. Chartists operate on a fascinating, albeit flawed, premise that history repeats itself in the stock market. They see a stock rising, observe a pattern, and assume it will continue to climb. They draw channels and resistance levels, believing these lines dictate future price action. To them, fundamental information about a company, its earnings, its products, is at best useless, at worst a distraction. What matters is the psychic value, the anticipation of how other investors will behave, building castles in the air on collective optimism. Here's the catch. Burton Malkiel, however, argues that this entire endeavor is a statistical illusion. He introduces the concept of a random walk, where future steps are unpredictable based on past history. It's like flipping a coin. If you get heads 10 times in a row, the probability of getting heads on the 11th flip is still 50/50. Malkiel dramatically states, taken to its logical extreme, it means that a blindfolded monkey throwing darts at the stock listings could select a portfolio that would do just as well as one selected by the experts. These perceived patterns are no more reliable than runs of luck at a gambling table. Academics, armed with computers, have rigorously tested hundreds of technical trading rules over decades. They've looked for momentum, the idea that rising stocks keep rising, and reversion to the mean for longer periods. But what they consistently found was this: even when some short-term momentum or reversals appeared, the patterns were too small and unreliable. Therefore, any attempt to profit from them was completely wiped out by transaction costs and taxes. It's the placebo effect of investing. Often, profits are made, but they're no better than what a simple buy-and-hold strategy would have achieved. You might be thinking, but I know someone who got rich following a tip. Or, what about all those gurus on TV? Malkiel would tell you that those are either anecdotes of pure luck or, more often, a misunderstanding of what truly drives returns. He points out that technical analysis is akin to astrology and every bit as scientific. Relying on these methods is not just futile, it's actively detrimental. Imagine waking up tomorrow having spent countless hours studying charts, only to realize that every transaction you made in pursuit of a signal chipped away at your capital, leaving you poorer than if you had simply invested in a broad market index and done nothing at all. The bottom line, don't chase shadows on the chart. Your efforts are far better spent understanding true value and embracing the long-term, low-cost wisdom of diversified investing, rather than succumbing to the illusion of predictable patterns. If you want a clear, evidence-based roadmap for building lasting wealth, subscribe to Audiobook Bites so you don't miss our next chapter on foundational investment strategies. 5. The Clouded Crystal Ball. Welcome back to Audiobook Bites, where we distill wisdom from literary treasures. Today, we're digging deep into Burton Malkiel's classic, A Random Walk Down Wall Street, specifically exploring the nuanced world of fundamental analysis. This is the method many traditional investors swear by, believing that true value can be found through careful study. Traditionally, the pros in the investment community have used one of two approaches to asset valuation: the firm foundation theory or the castle in the air theory. Fundamental analysis is the bedrock of the firm foundation theory. Imagine a financial detective poring over a company's balance sheets, income statements, and cash flow, scrutinizing management teams, and dissecting industry prospects. Their mission? To uncover the stock's intrinsic value, that firm foundation, and advise you to buy if the market price falls below it, or sell if it rises too high. This approach centers on four key determinants of a stock's worth. First, the expected growth rate of earnings and dividends. It makes intuitive sense. A company that consistently grows its profits year after year should be more valuable. We've all seen the magic of compounding, where even small, consistent growth over decades can turn a modest sum into a fortune. Second, the dividend payout. A company that distributes more of its earnings to shareholders, either through dividends or stock buybacks, should logically be more attractive. Third, the degree of risk. Less risky stocks, those reliable blue chips that hold steady during market turbulence, command a higher price because investors prefer stability over sleepless nights. And finally, the level of market interest rates. When interest rates are low, stocks become more appealing as alternative investments, pushing their prices higher. Conversely, high interest rates make bonds more competitive, drawing money away from stocks. Sounds logical, right? But here's the catch. Malkiel argues that forecasting future earnings is a most hazardous occupation. You might think, well, if I just estimate 10 years of strong growth, I can pinpoint the intrinsic value. But what if it's 11 years? Or 9? It's a bit like trying to hit a moving target while blindfolded. Small changes in your assumptions about growth rate or duration can wildly swing the intrinsic value you calculate. The truth is, there's a fundamental indeterminateness to a stock's exact intrinsic value. God Almighty, Malkiel quips, doesn't even know the proper price-earnings multiple for a common stock. But it gets worse. The very people advising you, security analysts, are often hampered by deep-seated conflicts of interest. These analysts are supposed to be impartial truth-tellers, helping you find good investments. Yet, their salaries and bonuses are frequently tied to how much lucrative investment banking business they bring to their firms. It creates a perverse incentive, recommend buy, and keep the corporate clients happy, even if it means glossing over underlying problems. Malkiel recalls an analyst who, after being confronted with a decimal error that inflated a stock's earnings, simply shrugged and said, "The recommendation sounds more convincing if we leave the report as is." You might be thinking, surely regulators protect us from this? While regulations like Sarbanes-Oxley aimed to improve transparency, human nature, and financial incentives remain powerful forces. The ratio of buy to sell recommendations during the internet bubble climbed to 100 to 1, even for companies burning through cash. Remember the Deepwater oil spill disaster with BP? Wall Street analysts, almost unanimously, called it a screaming buy, despite the massive uncertain costs ahead. They were wrong, and investors who followed lost dearly. The evidence is clear. Studies comparing analysts' forecasts to actual outcomes show they perform no better than simple extrapolations of past trends. In fact, some studies found their one-year forecasts were worse than their 5-year forecasts. It's a sobering thought, especially when one of the book's verified quote states, "Taken to its logical extreme, it means that a blindfolded monkey throwing darts at the stock listings could select a portfolio that would do just as well as one selected by the experts." This isn't just academic musing. It has real-world implications for your hard-earned money. The bottom line, while fundamental analysis provides a logical framework for understanding a company's potential, the real-world application is riddled with challenges. From the inherent difficulty of forecasting an uncertain future to the undeniable conflicts of interest that cloud expert judgment, relying solely on fundamental analysis to consistently beat the market is a perilous path. 6. A fair game? All right, let's confront a central idea that shakes the very foundation of how many people think about investing. The efficient market hypothesis, or EMH. It's a theory that, at its core, suggests the stock market is a remarkably smart, nearly clairvoyant system. The EMH comes in a few flavors, each building on the last. First, there's the weak form. This one posits that all historical price information is already reflected in current stock prices. What does that mean for you? It means studying past stock charts, looking for trends, or trying to predict future movements based on yesterday's ups and downs is, quite frankly, useless. It's like trying to predict the next coin flip by analyzing the results of the last 1,000. Malkiel puts it perfectly. Taken to its logical extreme, it means that a blindfolded monkey throwing darts at the stock listings could select a portfolio that would do just as well as one selected by the experts. Here's the catch. If prices move in a truly random walk, then knowing their past path tells you nothing about their future direction. Next, we move to the semi-strong form. This takes the weak form a step further, arguing that all publicly available information is already baked into a stock's price. Think about it. Company earnings reports, news articles, economic forecasts. If it's out there for anyone to read, then sophisticated investors have already processed it, and the market price has adjusted. This means that even diligent fundamental analysis, poring over financial statements and industry reports, won't give you a consistent edge. By the time you act on that information, it's already old news to the market. But it gets even wilder with the strong form of the EMH. This most extreme version suggests that all information, public or private, including insider information, is instantly reflected in stock prices. Now, this one is often debated, as it implies even illegal insider trading wouldn't consistently yield profits before the market catches on. The speed at which information travels today, though, makes you wonder how long any secret stays secret. So, why do stock prices move randomly if the market is efficient? Because new, truly unexpected information arrives randomly. If an event could be predicted, the market would have already priced it in. When real news hits, an unexpected breakthrough, a sudden crisis, prices adjust so rapidly that no one can consistently profit from it. The market is a ceaseless, lightning-fast information processor. You might be thinking this sounds defeatist, that there's no point in trying. But this understanding is actually incredibly empowering. Therefore, if you can't consistently beat the market by finding undervalued stocks or timing its movements, the most sensible strategy is to stop trying. Avoid the fees, the taxes, and the stress of active trading, which rarely pays off. Instead, own a slice of the entire market. The bottom line, investors would be far better off buying and holding an index fund than attempting to buy and sell individual securities or actively managed mutual funds. If you want to simplify your investing life and aim for solid, long-term returns, then make sure you're subscribed to Audiobook Bites. Our next segment will dive into the practical strategies for doing exactly that, ensuring you build wealth smarter, not harder. 7. Diversifying for resilience. Welcome back to Audiobook Bites, where we distill investment wisdom into actionable insights. Today, we're diving into part 3 of Burton Malkiel's A Random Walk Down Wall Street and exploring a truly groundbreaking concept, modern portfolio theory, or MPT. Malkiel introduces MPT as a new walking shoe for investors, a framework that forever changed how we think about building wealth. For decades, the investment world often saw risk as a simple, unavoidable downside. More return meant more risk, end of story. But MPT, a Nobel Prize-winning framework, offered a sophisticated new lens. It asks, what if you could achieve higher returns for the same level of risk, or even reduce risk without sacrificing potential gains? Here's the catch. To understand MPT, we first need to refine our definition of risk. It's not just the possibility of suffering a loss. It's what academics call the dispersion of returns, the variability of your investment outcomes. Imagine 2 roller coaster rides. One is a gentle climb and descent, predictable and smooth. The other is a wild, unpredictable series of drops and loops. Both might end at the same elevation, but the wild ride has far greater dispersion in its up and down movements. That variability, that uncertainty, is what MPT seeks to manage. But how can you possibly reduce this variability, especially when all investments seem to rise and fall together? This is where the magic of diversification, as championed by MPT, comes in. Malkiel illustrates this brilliantly with his island economy. Picture 2 businesses, an umbrella manufacturer and a beach resort. In sunny seasons, the resort thrives, but umbrellas collect dust. In rainy seasons, the umbrellas sell like hotcakes, while the resort struggles. If you own stock in just one, your returns would be incredibly volatile, swinging wildly with the weather. Now, here's the genius of MPT. What Markowitz discovered was that portfolios of risky, volatile stocks might be put together in such a way that the portfolio as a whole could be less risky than the individual stocks in it. By holding both the umbrella manufacturer and the resort, your overall investment experiences stable returns, regardless of the weather. One's bad season is the other's boom. This is diversification in action, effectively washing away what we call unsystematic risk, the risk specific to individual companies or sectors. You might be thinking, but what about market-wide crashes like the internet bubble or the 2008 financial crisis? Diversification can't prevent those, can it? You're right. That's systematic risk, the risk inherent in the overall market, which cannot be diversified away. Therefore, MPT doesn't promise to eliminate all risk, but it empowers you to strategically combine diverse assets to optimize your risk-adjusted returns by minimizing the unsystematic portion. It's about building a portfolio that is resilient, designed to weather various economic storms. Imagine looking at your investment statement, not with anxiety about individual stock swings, but with confidence, knowing your portfolio is a well-constructed ecosystem where different assets play complementary roles. The bottom line, modern portfolio theory teaches us that intelligent investing isn't about picking individual winners, but about creating a diversified, resilient portfolio that optimizes risk and return, setting the stage for steady, long-term wealth accumulation. The Get Rich Slowly but Surely book philosophy in action. 8. The elusive measure of risk. Welcome back to Audiobook Bites, where we distill investment wisdom into actionable insights. Today, we're delving into Burton Malkiel's A Random Walk Down Wall Street, specifically exploring the capital asset pricing model, or CAPM, and its intriguing partner, beta. This chapter is all about understanding the elusive measure of risk. Imagine the vast, unpredictable ocean of the stock market. Some risks are like local squalls, unexpected, isolated events hitting a single ship. Others are like vast, global currents affecting every vessel. This is the core distinction between unsystematic risk and systematic risk. Unsystematic risk is the unique, diversifiable risk tied to a specific company or industry. Think of it. A strike at a particular factory, the discovery of a new product by one firm, or even accounting fraud from a rogue executive. These are company-specific events that can dramatically swing a stock's price, but they can largely be mitigated through diversification. If you own enough different stocks, the individual ups and downs of these company-specific events tend to cancel each other out. Here's the catch. Not all risk can be diversified away. That's where systematic risk, also known as market risk, comes in. This is the risk inherent to the entire market or economy, like a major recession, a global pandemic, or a sudden change in interest rates. These are the powerful, overarching currents no single ship can escape. Now, to quantify this systematic risk, academics introduced a Greek letter, beta. Beta measures a stock's sensitivity to overall market movements. A stock with a beta of 1 is expected to move in tandem with the market. If the market goes up 10%, a beta 1 stock is expected to go up 10%. A stock with a beta of 2, considered aggressive, is theoretically twice as volatile. It might jump 20% if the market rises 10%, but also fall 20% if the market drops 10%. Conversely, a defensive stock with a beta of 0.5 would move half as much as the market. The capital asset pricing model, or CAPM, proposes that investors are only compensated for bearing systematic risk, the kind that can't be diversified away. It argues there's no extra reward for taking on unsystematic risk because you can eliminate it through smart diversification. So, to earn higher average long-run returns, you'd simply increase your portfolio's beta by investing in more aggressive, higher beta stocks. But here's where the wisdom of the market truly tests the theory. While CAPM and beta presented a seemingly elegant framework, the empirical record tells a different story. Studies, including those by prominent academics like Eugene Fama and Kenneth French, meticulously examined the relationship between beta and returns over decades. Their results were surprising. They found essentially no relationship between a portfolio's beta and its long-term return. High beta portfolios did not consistently produce higher returns than low beta ones. In fact, many financial publications ran headlines like, "The Death of Beta." You might be thinking, if these sophisticated models don't work, what good is any advice? This critical evaluation reveals a crucial point. CAPM theorized that higher beta leads to higher returns, but empirical studies showed a flat or even inverse relationship. Therefore, relying solely on beta as a predictor for long-run returns proved unreliable, challenging the initial promise of this new investment technology. This is why Malkiel so strongly advocates for simplicity and broad diversification. If even advanced mathematical models like CAPM struggle to consistently predict returns, it reinforces the core idea of a random walk. The bottom line asterisk, while beta helps describe volatility, it's not a reliable crystal ball for predicting which stocks will outperform, suggesting that investors would be far better off buying and holding an index fund than attempting to buy and sell individual securities or actively managed mutual funds. 9. The Investor's Inner Ape. Welcome back to Audiobook Bites. Today, we're delving into Burton Malkiel's seminal work, A Random Walk Down Wall Street, and exploring a chapter that challenges the very foundation of traditional investing, behavioral finance, the investor's inner ape. For decades, economic theory painted investors as perfectly rational beings, driven solely by the cold logic of maximizing wealth. But Malkiel reveals a fascinating, and often costly, truth. We are far from rational. Instead, our investment decisions are heavily swayed by deep-seated psychological biases, turning the market into a complex arena where our own inner ape can lead us astray. Imagine, if you will, the academic world's boldest jab at professional investors, suggesting that a blindfolded monkey throwing darts at the stock listings could select a portfolio that would do just as well as one selected by the experts. This seemingly absurd statement sets the stage for understanding why behavioral finance is so crucial. Because if the pros aren't truly beating the market consistently, then what is going on? Our journey into the investor's mind begins with overconfidence. Think about the last time you got behind the wheel. If asked, most people, including you, would probably rate themselves as above-average drivers. This illusion of superior skill extends directly into investing. We overestimate our knowledge, underestimate risks, and exaggerate our ability to control market outcomes. This bias often leads to overtrading. Studies have shown that the more individual investors trade, the worse their returns. Why? Because every transaction incurs costs and taxes, eroding potential gains. You might be thinking, but I know what I'm doing. But here's the catch. The data tells a different story. In fact, legendary investor Warren Buffett famously quipped that lethargy bordering on sloth remains the best investment style. Overtrading is a prime example of a stupid investor trick that sabotages long-term wealth accumulation. Next up, we encounter herding. Remember the dot-com bubble of the early 2000s? Or the tulip bulb craze of the 17th century? These periods saw people piling into wildly overpriced assets, not because of sound fundamentals, but because everyone else was doing it. The sheer excitement, the fear of missing out, created a powerful positive feedback loop. People heard friends boasting about astronomical gains. The media hyped new economy, stocks, and suddenly, logic flew out the window. But it gets worse. This isn't limited to individual investors. Even mutual fund managers exhibit herding behavior, often holding similar stocks if other managers in their city are doing so. The result? Instead of diversified opinions, we get collective optimism or pessimism, amplifying market swings. Then there's loss aversion, a bias that makes us feel the pain of a loss far more intensely than the pleasure of an equivalent gain. Imagine being offered a coin flip. Heads, you win $100. Tails, you lose $100. Rationally, it's a fair bet, but most people would decline. Why? Because the pain of losing $100 feels about 2.5 times stronger than the joy of winning $100. This leads to systematic errors, like holding on to losing stocks for too long, hoping they'll come back, purely to avoid realizing the painful loss. Conversely, we're quicker to sell our winners, locking in that sweet feeling of being right. This is non-optimal behavior that can lock in poor returns and forego tax benefits. Finally, Malkiel introduces framing effects, demonstrating how the way an investment choice is presented significantly influences our decision. A choice framed in terms of lives saved will elicit a different response than one framed in terms of deaths incurred, even if the underlying probabilities are identical. In the financial world, this means the marketing of complex products, or even the language used by financial advisors can sway us toward choices that aren't necessarily in our best interest. The bottom line Malkiel stresses that while the market will eventually correct irrationality, our own psychological biases can lead to costly mistakes along the way. To avoid these stupid investor tricks, you must first recognize them within yourself. If you want to understand how your psychology can impact your wealth and discover a clear path to successful investing, subscribe to Audiobook Bites so you don't miss our next segments where we explore practical strategies to build a resilient portfolio, including why investors would be far better off buying and holding an index fund than attempting to buy and sell individual securities or actively managed mutual funds. Don't let your inner ape control your financial future. 10. The new investment alchemy? We've heard about the lure of market-beating strategies, the siren call of promises that sound too good to be true. Now, let's peel back the layers on a relatively new phenomenon in the investment world. One that has attracted hundreds of billions of dollars, smart beta. The name itself conjures images of effortless, sophisticated outperformance, doesn't it? But is it truly smart, or is it just another form of investment alchemy? Smart beta strategies promise market-beating returns not by picking individual stocks, but by tilting a portfolio towards certain characteristics, or as the book calls them, tasty flavors. Think of it like this. Instead of just buying every ingredient in the market basket, you selectively emphasize ingredients that have historically done well. These factor tilts include things like value, focusing on stocks with low price earnings or price-to-book ratios. Small size, believing smaller companies historically generate larger returns. Momentum, betting that stocks already on a roll will continue to rise. Or low volatility, assuming less risky stocks can still deliver strong returns. The appeal is clear. Capture these historical advantages in a relatively passive, low-turnover way, supposedly without taking on extra risk. You might be thinking, what's not to like? But here's the catch. Many smart beta strategies, despite their passive veneer, are essentially active management in disguise. They involve making deliberate choices to deviate from the broad market, and every deviation carries consequences. When proponents claim smart beta funds generate excess returns, it's often because they are assuming different or greater risks, not because they found a free lunch. For example, a value-tilted portfolio might outperform during certain periods, but it does so by concentrating in companies that are often in financial distress, a clear sign of increased risk. Similarly, chasing momentum means riding a wave that can break with terrifying suddenness. It gets worse. These sophisticated strategies often come with higher costs. They require periodic rebalancing, selling winners to maintain their chosen tilts, which can trigger transactions costs and short-term capital gains taxes. Compare this to a traditional capitalization-weighted index fund that simply holds everything in proportion to its market size, rebalancing only when the underlying index changes. Those plain vanilla index funds are designed for minimal turnover and maximum tax efficiency. The book found that funds specifically designed to capture momentum and low beta effects haven't consistently delivered superior real money performance. While academic simulations might look great on paper, actual results in the market are often disappointing. The idea of a superior mousetrap often turns out to be just a riskier one. Therefore, Malkiel's long-standing advice remains remarkably relevant today. The core of every investment portfolio should consist of low-cost, tax-efficient, broad-based index funds. If you do wish to add some exposure to specific risk factors like small company stocks, do so through equally low-cost, capitalization-weighted funds for those segments. The bottom line, investors would be far better off buying and holding an index fund than attempting to buy and sell individual securities or actively managed mutual funds. If you want to build durable wealth and avoid these common pitfalls, make sure you're subscribed to Audiobook Bites so you don't miss our next deep dive into financial wisdom. 11. Embracing index funds. Welcome back to Audiobook Bites. Today, we're unlocking one of the most powerful and surprisingly simple investment strategies from Burton Malkiel's classic, A Random Walk Down Wall Street. The no-brainer step. It's about letting go of the complex hunt for winners and instead, embracing the elegance of owning the entire market. Since its first edition in 1973, Malkiel has championed a core truth. Investors would be far better off buying and holding an index fund than attempting to buy and sell individual securities or actively managed mutual funds. Think about it. The investment world often paints a picture of highly paid experts, with their intricate models and proprietary insights, all striving to pick the next big stock. But Malkiel famously points out, taken to its logical extreme, it means that a blindfolded monkey throwing darts at the stock listings could select a portfolio that would do just as well as one selected by the experts. A provocative image, isn't it? Yet, the data consistently supports this. Here's why this no-brainer approach isn't just smart, it's superior. Most actively managed mutual funds, those run by these very experts, consistently underperform broad market index funds over the long term. Why? The answer boils down to three invisible dragons: fees, trading costs, and taxes. Active funds come with higher expense ratios, sometimes eating up a full % or more of your returns annually. But it gets worse. Their constant buying and selling to try and find that elusive alpha racks up substantial trading costs, which further erode performance. Therefore, these combined drags mean that even if an active manager could pick winners before anyone else, the costs often swallow any potential advantage. Now, you might be thinking, but indexing sounds like settling for mediocrity. And it's true, indexing guarantees you the market's return, nothing more. But here's the often missed truth, that guaranteed mediocrity after costs consistently leads to superior net returns for you, the investor, compared to the vast majority of active funds. Imagine your portfolio growing steadily year after year, simply mirroring the economic engine of the entire market, without the stress, the endless research, or the expensive mistakes of trying to outsmart everyone else. It's diversified by nature, spreading your risk across hundreds or thousands of companies, and incredibly tax-efficient due to minimal turnover. You're not trying to find the needle, you're simply buying the haystack. The simplicity is its genius. You bypass the performance lottery of active management, the high fees, and the tax drag, keeping more of your hard-earned money working for you. The bottom line, for enduring wealth, stop chasing performance and start embracing the elegant power of the market itself through low-cost, broadly diversified index funds. If you found this insight valuable and want more actionable wisdom to refine your financial strategies, make sure to subscribe to Audiobook Bites. You won't want to miss our next deep dive into timeless investment principles. 12. Tailoring your portfolio to your journey. Welcome back to Audiobook Bites, where we distill the wisdom of financial giants. Today, we delve into Burton Malkiel's classic, A Random Walk Down Wall Street, focusing on his pragmatic approach to life cycle investing, a strategy that aligns your portfolio with your journey through life. Imagine your financial life as a long road trip. You wouldn't use the same vehicle or drive at the same speed if you're just starting versus nearing your destination, would you? Malkiel argues that your investment strategy needs to be keyed to your life cycle. A 20-something with decades of earning potential has a different capacity for risk than a 60-year-old on the cusp of retirement. The most important investment decision you will probably ever make concerns the balancing of asset categories, stocks, bonds, real estate, and cash at these different stages. Here's the catch. It's not just about what you want to do, but what you can afford to do if things go wrong. Your earning ability and existing financial obligations directly influence your capacity to absorb investment losses. Therefore, a younger investor with strong earning power ahead can afford a more aggressive, stock-heavy portfolio, ready to ride out market volatility. But as you get closer to retirement, your capacity for risk diminishes. Therefore, your portfolio should gradually shift towards income-producing, less volatile assets. But it gets better. Malkiel stresses the critical importance of early and persistent saving. He's often joked, indeed, a subtitle for this book might well have been the Get Rich Slowly but Surely book. He explains that the secret to this slow, sure wealth is the magic of compound interest. Every dollar saved early is a seed that blossoms into a tree, then a forest over decades, thanks to reinvested earnings. Neglect this, and you're forcing yourself into a desperate catch-up game later in life, often requiring significant sacrifices or pushing back retirement. Now, you might be thinking, what about taxes eating away at my gains? Malkiel preempts this with a powerful technique. legally stiffing the tax collector. Utilize tax-advantaged accounts like IRAs, 401k, S, and 529 plans. These aren't just perks. They are fundamental tools. By deferring taxes on growth, or even eliminating them entirely for qualified withdrawals, you allow your investments to compound untouched, dramatically boosting your final nest egg. It's not about cheating, but smart, strategic planning within the rules. But even with the right asset allocation and tax advantages, markets fluctuate. Therefore, Malkiel advises two powerful, yet simple strategies: dollar cost averaging and regular rebalancing. Dollar cost averaging means investing a fixed amount regularly, regardless of market highs or lows. This way, you buy more shares when prices are down and fewer when they're up, naturally lowering your average purchase price over time. It's an automatic pilot that keeps you invested, preventing you from making emotional, costly timing mistakes. And rebalancing? Imagine your target is 60% stocks and 40% bonds. If stocks soar, your portfolio might become 70% stocks. Rebalancing means selling some of those high-flying stocks and buying more bonds to restore your 60-40th balance. This isn't just about maintaining your risk level. It's a disciplined way to sell high and buy low. Malkiel calls systematic rebalancing the closest analog we have to a genie reliably telling us when to buy and sell. The bottom line: successful investing isn't about clairvoyance or chasing hot tips. It's about disciplined, age-appropriate asset allocation, leveraging tax-advantaged accounts, and sticking to proven strategies like dollar-cost averaging and systematic rebalancing. If you want to continue equipping yourself with time-tested financial wisdom and ensure you don't miss future audiobook bites, subscribe now. 13. The timeless lessons and who this is not for. We've journeyed through the wild fluctuations of markets, explored the siren calls of speculative bubbles, and dissected the intricate theories promising to beat the odds. As our random walk down Wall Street concludes, it's time to distill the absolute core of investment wisdom, the principles that have stood the test of time, generations, and countless market upheavals. The first, and arguably most potent, lesson is the power of broad diversification. Imagine casting a wide net instead of trying to spear a single, elusive fish. By spreading your investments across many companies, industries, and geographies, you inherently reduce risk. You avoid the catastrophic impact of any single bad bet, allowing the overall tide of economic growth to lift your portfolio. But there's a crucial component to making this work: keeping costs relentlessly low. High fees, hidden charges, and excessive trading are silent wealth destroyers. Here's the catch: the market is a wily opponent, and many are drawn to its perceived quick wins. You might be thinking about the thrill of picking the next big stock, the satisfaction of a perfectly timed trade. But Malkiel's extensive research consistently points to a simpler, less dramatic, yet far more effective approach. As he concludes, investors would be far better off buying and holding an index fund than attempting to buy and sell individual securities or actively managed mutual funds. Why? Because index funds offer broad diversification with minimal costs, faithfully tracking the market's long-term upward trend. But, therefore, this advice is not for everyone. This book is not for the speculator chasing instant riches, the day trader addicted to the thrill of short-term swings, or anyone who believes they can consistently outsmart the collective wisdom of millions. It's not for those who seek validation for complex, high-cost strategies that ultimately erode returns. This book and its timeless lessons are not for those who cling to the castle-in-the-air theory, hoping to sell to a greater fool before the inevitable crash. Instead, as Malkiel suggests, indeed, a subtitle for this book might well have been the Get Rich Slowly But Surely book. This wisdom also extends to the habit of annual rebalancing, a simple act of returning your portfolio to its intended asset allocation. When one asset class soars, you trim it back. When another falters, you buy more. This counterintuitive discipline forces you to buy low and sell high automatically, without needing a crystal ball. Imagine a boat steadily course-correcting through the waves, rather than letting itself be tossed wildly by the latest gust of wind. This unwavering commitment to the long term is your shield against irrational exuberance and panic-driven selling. The bottom line, for those committed to the steady, quiet work of building genuine wealth, the path is clear, simple, and remarkably effective. If you want a guide to financial peace of mind and lasting prosperity, stay with the fundamentals and tune in for more audiobook bites.